Good afternoon and welcome to the Phoenix 6th General Membership Meeting. Capital Raising Amidst Challenges of Structural Underperformance, presented by the Capital Markets Development Committee and Programs and Meetings Committee. Let us welcome our host. He's the chairman of the Capital Markets Development Committee, Mr. Manny P. Ocampo.
Good afternoon, ladies and gentlemen. We looks like we have a good crowd this afternoon. So, uh, well, welcome to the sixth Phoenix General Membership Meeting with the theme "Capital Raising Amidst Structural Challenges in the Economy." This GMM is, as mentioned, presented by the Programs and Meetings Committee in partnership with the Capital Markets Development Committee. I will be your host this afternoon, and let me please call on stage our president, Mr. Wilson Tan, to call this meeting to order.
Good afternoon. Let me call the meeting to order. Shall we all stand up, please, as we have the invocation and then the national anthem.
Let us put ourselves in the presence of God. Dear Lord, we offer this gathering to you and ask you to bless it with your wisdom and grace. We thank you for this opportunity for us to be together. We ask that you enlighten our minds and pour out on us the spirit of understanding. Guide us in our discussions and help us to know what it is pleasing to you. We ask this through Christ our Lord. Amen.
Mga kababayan, ang pambansang awit ng Pilipinas.
Please be seated. To our distinguished speakers, fellow Phoenix members, friends from media, guests, good afternoon once more. As we know, the global capital markets face a very tough year in 2022 and will most likely remain challenging for the rest of this year as we still recover from the adverse effects of the pandemic, also compounded by the pervasive impact of geopolitical developments that have contributed to this high interest, high inflation environment we are in. Priorities of investors as well as preferences of consumers continue to evolve at a rapid pace, in part due also to the growing emphasis on, say, ESG and sustainability concerns. We also have seen the emergence of new technologies that are expected to further heighten the level of disruptions. As we note, as companies continue to recover from the pandemic and they want to expand and explore new opportunities, they also need to have fresh infusion of capital, be it through equity or debt. But with this change in the consumer direction as well as investor focus, and with the market still reeling from the aftermath of the collapse of, say, the FTX, the Silicon Valley Bank, and Credit Suisse, the question is how will the capital raising evolve? So this afternoon, we are very fortunate to have a well-known Filipino global investment banker to share with us his experiences, insights, and vision on capital raising in the region. You see, whenever I see him on TV and listen to him, I always look forward to his provocative perspective. So let's expect that this afternoon. We also have a senior executive from the country's stock exchange to discuss their initiatives to improve the country's capital market. So they will be properly introduced later on. I also would like to appreciate the efforts of our Capital Markets Development Committee, led by Manio Campo here, co-chaired by Manio Campo and also Nino Nakpil, Vice Chairs Pam Victoriano and Abby Magpayo, and Liaison Director Sondi Garcia, as well as our Programs and Meetings Committee, chaired by Nene Jesus, and of course, Liaison Director Tony Boy Omsiaco, for bringing this event together. Since our last GMM last May 30, about 3 weeks ago, here are the activities that we have so far. So last May 30, the Environment Committee held a sustainability forum entitled Solar Evolution, Generate, Conserve, and Contribute at the New World Hotel Makati under the leadership of Chair Beth Coronel and Liaison Director Attorney Ebot Tan. Also, June 15, last week, the Sports and Wellness Committee held its kick-off golf game at the Alabang Country Club, led by Chair Arthur Chung and Liaison Director Ador Abrujena. So we look forward to more golf tournaments maybe in the next quarter or so. And then for the next weeks and months, we hope you will attend some, if not all, of these activities. Our very much proactive ICT committee, remember they sponsored the last GMM, led by Chair Attorney Mark Goriseta, Vice Chairs Bong Paloma and Adrian Abrujena. Of course, Liaison Director Sondi Garcia will host the webinar Fortifying Your Business, the Indispensable Imperative of Data Privacy and Cybersecurity. This will be on June 29 at the Dusit Tan Hotel here, 12 noon, and the sponsors will be RCBC, Sonic Wall, and AMTI Synergy. Then the Good Governance Committee, led by co-chairs Cathy Ang and Rod Franco, co-vice chairs Marivic Espano and Risa Latorre, and project lead Baby Nuesa and liaison director Terry Magleo will also hold a webinar entitled Enriching Public Governance in GOCCs. That will be on July 25 at the press room of New World Hotel. Then the Professional Development Committee, in partnership with Ayala Corporation, will hold the 6th Ayala Finex Finance Committee on August 10 at 9 a.m. at Fairmont Hotel, Makati. Then, of course, we look forward to the staging of the 17th ING's Finex CFO of the Year Award. The official launch will be announced soon, and the unveiling of the winner will be sometime in November. So we would like to encourage you to nominate your CFOs to vie for this much coveted award. And of course, the Phoenix Week that will be from October 2 to 6. And this year's theme is Navigating Global Uncertainties Towards Sustainable Growth. So various Phoenix committees are involved in this activity and will sponsor activities and sessions throughout that week. Of course, there will be an in-person conference event that week that will be a Friday, culminating in the Phoenix Night on October 6. So please mark your calendars for this event. Then soon, in partnership with KPMG, RG Manabat and Company, there will be a CFO study that will be conducted, and we hope that you will all participate in this because the results will be very beneficial to all CFOs and other finance executives. So that will be initiated in partnership with KPMG. And then we will soon also be adapting or acquiring a software application so that we can better improve our service to the members as well as the announcement of events. So the details will be announced as soon as the agreement is finalized. I also would like to encourage everyone to support the initiatives of the Phoenix Foundation and Phoenix Academy. So the ninth offering of the Capital Markets and Fixed Income course will be this August. And of course, the third run of the Senior Finance Leadership Program designed for new and aspiring CFOs and C-suites with finance oversight. This has commenced, started last June 14. There are other two programs that will be launched later, hopefully during the year. Then we continue to accept sponsorships, no, for our year-round activities. The packages are shown on screen. Also, it will be at the partner level for 2 million, platinum at 1, diamond at 750, gold at 500, and patron at 300. So far, we have generated good amount of sponsorship, and we appreciate the sponsors for this year-round event. I think right now we stand at about 8.7. We would like to breach the 10 million mark soon. So sponsorships are all welcome. At this point, let me acknowledge our sponsors, our sincerest gratitude to the following. Of course, the Union Bank of the Philippines, First Philippine Holdings, LT Group, Converge ICT Solutions, PNA Grant Thornton, Robinson's Land, Shell Filipinas Corp, Steel Asia, Manufacturing Corp, KPMG RG Manabat, BDO Unibank, DMCI Holdings Corp, Isla Lipana and Company, PricewaterhouseCoopers, Stratcom, and of course SGV and Company. So the strong support from our sponsors shall enable us to undertake our programs for the rest of the year. So in tandem with the sponsorship, we also would like to encourage the participation of each one on our ongoing recruitment program. We want to expand the membership of the institute, especially coming from the listed entities and those that are belonging to the top 1,000 corporation. So these are some of the activities that we have laid down, and we will do further announcement as we go along this year. So again, thank you very much for your help, and we look forward to a very engaging discussion this afternoon.
Thank you, President Wilson. So now I understand that our guests are ready. Before going to that, I'd like to just acknowledge the presence of our past Finex presidents this afternoon. Ms. Judith Lopez, our Finex president 2013. Thank you. And Mr. Jose Jerome Pascual, or Jeng, the past president 2020. Allow me now to introduce, and we hope you'll give your attention, given the sumptuous lunch we're all having. Our first speaker this afternoon, who should provide a very provocative discussion point, is Mr. Stephen Konying. Stevie is a well-renowned global investment banker. He has a strong track record in advising prominent local and foreign companies and leading initial public offerings, equity and debt and advisory transactions in the Philippines, Thailand, Indonesia, and the wider Asia-Pacific region. Mr. Konying served as the former chairman and CEO of Evercore Asia, and he was the vice chairman for the ASEAN of the Macquarie Group. He was also the managing director at Merrill Lynch Asia Pacific, Salomon Brothers Hong Kong, and director and investment banking head for Morgan Grenfell, and was the managing director for PCI Capital, you know, just when the boom in the equity markets started back in the 90s. Mr. Konying is also the senior advisor to PAG and is a member of the Executive Advisory Board for Asia of the Wharton School of Business. He is likewise an independent director for several corporations, among them the First Philippine Holdings Corporation, Philippine Bank of Communications, Century Properties Group, and Phoenix Petroleum Philippines. Mr. Konying graduated from the Ateneo de Manila University and the Ateneo School of Law and completed a Master of Business Administration in Finance from the Wharton School of Business. He is also, I believe, you're also with the New York Philharmonic Orchestra, so he is there. And Mr. Konying also was, you know, in a previous lifetime, also, shall we say, an active participant in, you know, going up shall we say, on radical matters. He was there, so sorry, on changes. Maybe I'll put it that way. Mr. Koning was there. So, Mr. Koning, thank you.
First, thank you very much for inviting me and for the kind words. And it's always a pleasure since I used to be a member of Phoenix from 1990 till 1993. And it's nice to come back. And this is the second time you've invited me. The last time we were all on Zoom because it was the peak of COVID. So nice to see we've all survived and prospered. Uh, I'm not going to talk about, I decided today to talk about something bigger. Basically, my thesis is, unless we address these issues, we are doomed to underperformance as a country, regardless of who's president, regardless of which political system we follow. So let me, on that happy note, explain why. Why do we have structural underperformance where our history over 70 years is having every Asian country with sizable population surpass us in GDP per capita? Not some, all. First, we have expensive and inadequate infrastructure. We don't have manufacturing. Every manufacturing job creates 5 other jobs. Every OFW creates 0 jobs. If we're relying on growth by sending people away, there's nothing created here. Every job created here in manufacturing, if you look at other countries, on average creates 5 jobs. What else? We have Malthusian population levels and destiny. My first caveat, I'm not a religious person, so if you get offended, I'm not religious, I'm just going to speak the facts. If you believe Malthus, eventually the inexorable rise in population, if not checked, will exceed the growth in productivity, in food production and space. My view is we have reached belatedly, but definitely that point in the country. What are the short-term issues? All right, we have decent GDP growth, but it comes from the worst economic performance in the region during COVID. While GDP was decelerating and quarter 2023 showed decent expectations, we're only gone back to where we were in 2019. All the other countries are in major countries in Asia are beyond that. So let's put things in perspective. We're celebrating a return to where we were 4 years ago, and the others have gone beyond. They all suffered like us. They all decelerated like us. But we suffered more and we grew less. What are the short-term issues? As I said, lack of manufacturing and long-term planning. And this is something I feel is very important due to the leave it to the private sector attitude that is, sorry? Okay. The leave it to the private sector attitude, which has led to high exposure to something that has become important to understand post-COVID, which is imported inflation. This is inflation you did not cause, but happened to you. Let me give an example. Everybody initially had to deal with higher gasoline prices. Why were we affected the most in Southeast Asia? Because we have the least take-up of hybrid cars, electric cars, and the worst mass transit. If in China, majority of cars sold, new cars sold are electric. And if you go to Bangkok, you go to Singapore, you go to Kuala Lumpur, and you go to Hong Kong, most of the taxis are now hybrid. A decade ago, most of them are Priuses. The taxis in Hong Kong use LPG, and the buses are electric or hybrid. Then your percentage exposure to imported inflation from oil is less. If your mass transit is also more efficient, then your use of gasoline per capita for transportation goes down. This doesn't happen by leaving it to the private sector. We may not have a sterling track record in efficient government planning, but it doesn't mean we shouldn't do it. China, you read the articles, they made it a point a decade ago to say we have to be not good in electric cars. We have to be the leader. Now they are the leader. Half of Tesla's cars are made in China. And many of the new cars come from there. And now, if you buy an electric car in China, there is no price differential with a normal internal combustion car. They started out with a policy. They initially gave subsidies, but the subsidies were targeted towards certain levels of production cost and efficiency. And when they were gradually meeting it, they were gradually easing up the subsidies so that guess what? No more subsidies now. The electric cars are cost competitive with an internal combustion car. That didn't happen by leaving it to the private sector. It happened with conscious policy and planning. As I said, look at the example. Same thing with renewable energy. People have said Massachusetts in the US is the Saudi Arabia of wind. Because of the level of wind and the shoreline, it can basically supply the power for much of the eastern seaboard. Again, that happened through a combination of subsidies, planning, permitting, and all that stuff, and then easing it into market. It's not saying it's a permanent subsidy. It's not saying it's permanently inefficient. It's also not leaving it to the private sector. It is government planning, partnership, and execution. Remember during COVID, we were wondering when the vaccines would come. Thailand said, let's make it under license. Taiwan said, let's make it under license. China made it for themselves. Why did we have to wait for imports? We have zero manufacturing capacity for making vaccines, even under license. We were hoping that the Serum Institute of India was going to send us AstraZeneca, but they said, because of the explosion, we're going to reserve it for ourselves. That's what happens when you just wait for efficiency and leave it to the private sector. Some things are too important to leave to market forces only. You cannot ignore market forces, you cannot ignore efficiencies, but you cannot also just leave it to that. Anybody who believes that is dreaming. What are the immediate opportunities? Obviously, we have to do something about agriculture. I've never seen a nation starved into prosperity. Mining, which is already here. The nice thing about mining, you have to go where the minerals are. We have some. Renewable energy, it's there. And tourism, it's there. What are the long-term issues? This is the number one, which will doom us to failure. Lack of manufacturing. How bad are we? Pathetic. The best example is look at peak power demand and population. The Philippines with 117 million, well, depending on how many give birth the next few days, maybe 118, I don't know. We have peak power demand of 16,000 megawatts. We have GDP per capita of about 3,300. Vietnam, with 99 million people, about the slightly lower 2,900 GDP per capita, but purchasing power parity, they're already higher than us, 60,000. 4 times more power than the Philippines. And just to show you it's not an anomaly, look at Thailand, look at Malaysia, look at their peak power demand. Malaysia with with roughly 1/4 our population uses more power than us. Same ratio, 4 times Thailand, Vietnam, 4 times Malaysia on a per capita basis. That's what happened. Why? You build a mall, maybe Mega Mall uses 10 megawatts. Okay? Right, wonderful. You build a factory, you're turning iron ore into steel. 45 to 55% of your cost is power. The lack of power demand shows the lack of manufacturing. That's the best example. When people were trying to check in the 1990s whether China's reported growth rates were true or not, the way people checked on it was to check power demand and power usage. Now, I started tracking this about 3 years ago. Okay? 3 years ago, our peak power demand was 15 megawatts, 15,000, and our population then was 110. 3 years ago, Vietnam was at 97 million. They grew to a whopping 2 million while we grew 7. And they went from 45,000 megawatts to 60. I'm talking about 3 years. That is the compounding effect of manufacturing. And this is the lack of compounding effect of BPOs and OFWs. There's nothing wrong with BPOs, but don't think it's the solution to mass employment when you have a big population. Now, what is the problem? When I was born, 1959, I'm 64 years old, there were 19 million Filipinos. So we've added in my lifetime nearly 100 million Filipinos, when there was less than 20 when I was born. And what's everybody say a lot of, which I consider nonsense, demographic dividend. Oh, we're so lucky. We have so many people young and working age. I'm going to explain that in a minute, why I think, at least in the Philippines, it's nonsense. Okay, look. Japan, they're poor, no? And they got poorer. And they have the oldest population. They went from 1950 to today, from 84 million to 123. So don't worry, given a few years, we'll be bigger in population than Japan. 46%. Even China, which had the most draconian population policy, literally 2 people, 1 child. And if you're not married, no child. So less than 1 child per couple, because not everybody's a couple. Went from 554 to 1.4 billion, so they grew 262%. Look at the champion. Pakistan and us. Now, you tell me, is anybody copying our economic model? Now, at least we're number 1 in something. Okay, now, remember that last page. Now look at this page. What do everybody say? Oh, you have an aging population, that's bad. You have a demographic dividend with a young population, that's good. For 40 years, until recently, China has had a one-child policy, the most regressive population growth policy. How much have they grown since 1960? 152 times. So what? I thought they needed a demographic dividend and not having an aging population to grow. We, with our go forth and multiply mentality, grew 12 times. You think, oh, magaling ang 12 times. US, which was already rich in 1960, grew 26 times. We grew less than half the rate of the US, which was already rich compared to us. Now, people who took a middle ground, Thailand grew 81 times. Even India grew 31 times. That's just the truth, okay? That's the compounding effect of manufacturing and having a proper population policy, rather than adding mouths you cannot feed or educate or house. So if the demographic dividend is good, we've been living it since independence. So why is our performance so bad? This is through dictatorship, democracy, whatever system, any president. So I'm taking it over 62 years. I'm not picking on anybody. We grew 12.7 times. And China, including its hard times, because that doesn't include the Cultural Revolution and all that stuff. So you had basically a 20-year period for the first 20 years where they didn't get going. So it's only the last 40 years, 152 times at the peak of their one-child policy. What else? We're a very densely populated country. All you have to do is travel another country. You'll see so much countryside, forests, jungles. We have subdivisions. All right? Now, you look at the population per square kilometer, which means how many people per square kilometer. The US has 35. Okay, you can say Bangladesh and India have more. But we're getting there, okay? We're number 23 with 200 countries in the world. But I think we would rate higher if we took out the fact that we have 7,000 islands, many uninhabitable, a big shoreline. So what percent is actually arable? What? Maybe 2/3? You take out 2/3, you multiply that. We're above India already for population density. And I don't think anybody thinks India is a sparsely populated country. So when you factor in our topography, we're not just overpopulated, it's already a breaking point in density. Now, you wonder about agricultural production. If we barely created enough rice to feed people when I was born and we had 20 million people. How much does productivity have to increase if you now have close to 120 million people and you're reducing farmland because you have to house your 100 million new Filipinos you've created over 60 years? How? We're not reclaiming islands. So what are the long-term issues? Washington has given up on the Washington Consensus. We have not. Just look it up. Just put Washington Consensus. You'll see just last week, the New York Times article on saying how all the things on open trade and everything have been proven inadequate and they have abandoned it. You know, just-in-time inventory has become just in case. You actually need inventory. You can't rely on supply chains being robust anymore. And again, we failed to move beyond these. And let me say something. Have we had lousy government and lousy execution? Yes. I am not naive who thinks we should just go back to having government services, all right? I remember before the water distribution was privatized, many people in this room are old enough. What happened when you went to the men's toilet? Ice in the urinal. Why was there ice? Because there was no water. You went to the ladies' room, Valdez, outside. Why? Because there was no water to flush. So trust me, I'm not romantic about the level of government services. But we have to differentiate between what is profit-oriented, which the private sector can do decently, and what is developmental and forward-looking. Eisenhower, in the 1930s, when he was a captain, was told to go from the East Coast to the West Coast from a logistics purposes to see what would happen if they had to transfer military equipment and troops in case it was a Pacific War versus an Atlantic War and vice versa. It was so bad, it took him 3 weeks. I mean, it wasn't just, I'm going to travel through back roads. It's bringing tanks, bringing things. So he said, so when he became president, he started the interstate highway system. A system that has never stopped. It's now been 70 years. Every year, they expand the road network. It's not, oh, there's a backlog now, let's build. No, let's do anticipatory infrastructure. Before the 1980s and 90s, they used to have this term, flyover states. In other words, you fly over them. There's nothing there except farming and cotton. Now, BMW does their cars in Alabama, Toyota in Kentucky. Why? Because of the interstate highway system, which made them accessible. You didn't have to limit yourself to Michigan and Ohio anymore. Changi Airport. Does anybody think it's a crowded airport? And by the way, it's publicly listed as well, okay? They're building their fifth runway. Why? In anticipation and to lure more traffic. The traffic is not there. It's not there to meet. They're doing two things. They're enticing it and they're anticipating it. So that when I started going to Singapore, there were 2 terminals. Now there's 5. When I went there, there were 2 runways. Now there's 4. In a few years, there'll be 5. Hong Kong, the same thing. If there's a country that was hit so hard by COVID and tourism and travel, it was Hong Kong. What are they doing? Building a 5th runway. What are we doing? Debating where, what, when, how, terms. So here's the fallacy of the demographic dividend. Okay? The demographic dividend is used to explain countries like Scandinavia, Japan. The Scandinavian countries and Japan. Why? You have an aging population and you have full employment. People forget the second part when discussing the Philippines. If you have a population that's declining, and so therefore you have a workforce that's declining, and you have full employment, you have a problem. But it's a high-class problem. It can be solved with immigration, it can be solved with efficiency, it can be solved with automation, and you deal with the pension issues as they come. We have about 15 million immigrants and OFWs. For me, the ultimate vote is not the vote for Marcos or Aquino or Duterte. It's the vote to lead the country. We're telling about 1/4 of our working population, go. If you stay here, you will starve. That's the ultimate vote. And in a high population country, industrialization is the only mode to prosperity and full employment. Because it's a mass employer and it's a mass creator of additional employment. As I said, a guy who leaves to be a OFW, how many jobs does he create here? Nothing. He supports his existing family, but he creates new jobs. No jobs. Manufacturing in this country does. In any country does. There's the ratio. We have 1.5 million BPO workers. So what? About 1% of our population. But 10% has said, let's go. We cannot go from agriculture to service economy with our population. The first BPO country was Ireland. In the late 80s, they became the back office for insurance companies and healthcare companies in the US. They have 5 million people. You can be a big player when you have a small population to support. But BPO will never be a mass employer for 100 million plus population. There aren't that many jobs. What must we do? I don't have to read what I wrote. It's there. Let me say something. It's not just cost, it's not that everything. It's the quality for education. Okay, I had 3 clients. One's based in the US. I was on their board. It's a NASDAQ company with, when I joined, the $2 billion market cap, now a $1 billion market cap because tech prices collapsed. But basically, okay. And 2 OEM companies in China. All of them in 2016 were worried after Trump started having the tariffs and everything. Okay, on all 3, one had most of its data programmers in Shanghai, the other 2, most of their manufacturing was in Shenzhen and Guangzhou. They all said, we need to second source. One of them was even owned by a Filipino Chinese, okay? And they were all looking at the Philippines. The Filipino Chinese even already was looking at the factory in China. In Cebu. All three went to Vietnam after analyzing it. And you can argue the manufacturing because of the cost of power, infrastructure, but the data programmers, I said, huh? You chose Vietnam over us? And they said, a second-tier Vietnamese graduate scores higher than a top-tier Philippine graduate and costs less. See, we're so worried about speaking English rather than understanding what we're reading and writing. You want to be able to talk with a passable accent in a business call center and for customer service, fine. You want to be higher up, better jobs, actually writing code, writing programs. It's comprehension, not language. And our comprehension is already behind other people. What else did they tell me? The tech company said, not only are the scores higher, they said, in the Philippines, we hire them. They insist on being in a nice building. They have to be in Makati or Ortigas. They said, in Vietnam, they're happy to be in a second and third city because the same pay goes further. Why? Again, back to our infrastructure. Because it's actually decent infrastructure, decent everything in second and third cities. Versus here, basically saying we have to have the amenities. So they said, in the end, how much different was the productivity, cost per employee, payback period? Okay. Because never mind the manufacturing, that one I understand. But the tech guy, he said 35% more efficient in Vietnam. Productivity, cost, output. What do we need? The solution's not easy, but we don't have a choice. So, sorry to be so upbeat, but I just wanted you to understand the underlying facts. Until we address those, we're just addressing the rounding errors in our GDP growth versus our fundamental issues to provide employment, to provide sustained growth, and to stop falling behind all our neighbors. So on that happy note, thank you for inviting me again.
Thank you, Stevie. So I guess we will have a very active Q&A session after our second speaker. Now, to introduce our second speaker this afternoon. Our second speaker is Attorney Roel Refran. Attorney Refran is the Chief Operating Officer of the Philippine Stock Exchange and is also a fellow Finex member. He is a CPA lawyer and holds an MBA from the Emory University's Poiseta Business School in the US, where he was a Fulbright scholar. Attorney Refran also worked as an associate at the Emory Center for Alternative Investments, where he was immersed in alternative investment issues pertinent to private equity, hedge funds, and venture capital. Roel earned his Bachelor of Science in Business Management and Accountancy degree, magna cum laude, from the University of the Philippines in 1995, and his Juris Doctor degree, second honors from the Ateneo Law School in 1999. He is an adjunct faculty member at the Asian Institute of Management. He is also a professional lecturer at the University of the Philippines Virata School of Business and a recipient of the Distinguished Alumni Award from the University of the Philippines in 2014. On a personal note, Roel is an accomplished long-distance runner, having a number of half marathons and full marathons, and maybe 2 or 3 ultra marathons under his belt. In a past life, he was also a medalist in a number of Mr. Philippines bodybuilding competitions, and has obviously kept up this discipline. Ladies and gentlemen, let us welcome Attorney Roel Refran.
Good afternoon, everyone. I hope everyone is well. And I was listening to Stevie's presentation, and I could not help but not in agreement. No. But I think for the next couple of slides, I thought we'd share with you what probably some of you have observed. Some of you may be very familiar. But nevertheless, I thought there are some important points. When you look at, so Stevie was mentioning the structural from a macroeconomic perspective. Now we go to the capital markets, which I would always say should mirror the real economy. So I work for the Philippine Stock Exchange, and the Philippine Stock Exchange does actually not have a monopoly on capital raising, right? Especially if you look at the landscape now, there's crowdfunding, and the importance of accessing these funding opportunities even outside of the formal capital market. So there's equity crowdfunding, there's debt crowdfunding, but of course, over and above that, there's the traditional bank loans and all that. But the benefits, as the others have seen, of listing in the exchange, we always continue to share that story and that narrative. As we grow from where we are right now, we have only 287 listed companies now. But nevertheless, some people also do not realize that the exchange also is a for-profit company outside of it being a regulator. Okay? So what that means is we are also entrusted with the responsibility to enable, as we see, the growth of the capital markets. And I'll give you an example. When we look at the retail participation any given day in our market, that's right around 19.6%. But if you look at the total population, we only have around 1.7 million individuals who are actually investing. And that's not a very good statistic that I could share with you. So we thought maybe if we could partner with electronic wallet providers, the e-wallets. We have what? The number one probably have what? 65 million up. And then the second would probably have around 40 million any given day. So right there, you already have 100 million Filipinos. But what we see is that it's a culture shift. People would always look for the quick buck and all that. So, but we're not giving up on that. So that's one aspect when you look at the technology provider story of the Philippines. Second one is back 10 years ago, we initiated what's called direct market access. And this was the advent of online trading. Probably remember 13 years ago, all these stories about high frequency trader and all. So right off the heels of that, we addressed a need in the market to have the traditional model replaced with probably a more efficient model. And that's online trading, whether it's sponsored access or straight through. We can go into this detail. But what we're saying is that highway is there for the cars to traverse. And we feel that as we look at other technologies now, there might be use cases, with whether it's post-trade, most likely in the post-trade where there's a lot of talk about blockchain technology and DLT. Probably that's something that we would be very conservative about and learn from the experiences of other jurisdictions first. So, of that story, we always look at headline news. What's the PSEI now? We saw better days back in January 29, 2018, where we hit the peak. I thought we were gonna go up and up, but I've learned in my almost 2 decades in the capital market that there's no such thing as up and up, right? So everything goes in cycles, prices, markets go in cycles. Right now we're doing, I would say, at 6,400 levels, we're probably hitting more than probably the levels when more than 7, 8 years ago, right? So at 6.4, it's always a story of it's too low, but some people see an opportunity there. Maybe it's also good for them to come in. Okay? But this is important for us when we look at how the market is doing. Probably what we see on a given day is that we're looking at 5 billion pesos daily average turnover. before the pandemic, we were doing 8, 9 billion. A good day would be 10, even higher, exclusive of block sales. Now, this is really just a regular market. But who's contributing to that daily value turnover? It's important for us because if it shows it's the retail sector and it's the local pulling our own weight, then it's a good story for us to go out and tell the foreign institutionals, come in. We believe in our market. No? But here what we're saying is, it's really still the institutional accounting for it. No? Whether it's the GFIs or it's the QUIBs. And that's been a steady more than 78%, 79, almost 80% for the 5-month period for this year. The right-hand side of the screen is something that has probably changed. When I first joined back in 2005, it was the other way around. It's really just the foreign accounting for probably around 60%. But now it's the reverse, and probably Stevie, that's because of liquidity in our market now. Maybe people have more money, give and take the per capita challenges that we have. And I'd also probably say because of regulations, it's not also very easy to transfer money because of AML restrictions. No? And AML laws came about 2001. And I've seen that these regulations do have an effect on, actually, it's my term, trapping liquidity within the market. No? It's not as readily easy for you to wire money. And so there's the home bias effect. I would rather invest in the Philippines. So I'll take this away and then go back to, that's the story, but how's the capital markets been doing on an annual basis in terms of IPOs? We are probably, we were surprised during the pandemic because some issuers were very aggressive. So in 2022, for example, we had 10 IPOs. In 2021, we did hit the record high in terms of total capital raising. But to us, it's really companies that are probably representing the SME market, more on the medium than the small. Right? The micro also would not cater, would not address the requirements of the regulators, but more on the medium to the small on the SME side, or even the emerging companies. Why? Because these are probably the companies that at some point would also graduate to the main board, and that's a story that we'd like to share to everyone. But that being said, we know that in today's market, IPOs are drying up. No? People said we will do this fundraising. I see a couple of underwriters here, but they say, let's hold off for now and wait and see whether that's up to the end of the year, or we don't know when that would actually reverse course. So this is our story. And when you look at, I go back again to the domestic absorptive capacity. And probably in today's market, domestic can absorb 1 billion, 2 billion, any offering. But pre-pandemic, probably around 5 billion up, maybe 5 billion max on the domestic side. Any higher than that, probably you need to tap and have an international tranche. And here, the right-hand side of the screen is, I've noticed this, from 2020, there's been a lot more downsizing of deals from the time it's filed with us and the SEC for registration purposes. And normally, you look at the up to amount, and up to what amount are they looking at, subject to book building, up to what price and all that. But closer to the price fixing, as and when they do their rounds and you fill up the books, the story has been it's tough to fill up the books, even with the promises given from the foreign institutionals. And so that's a tricky proposition because we've seen, for example, in 2022, 6 companies initially said that we will do a 109 billion, but in the end, they did only a 74%. Remember, they filed, they said we're going to do 109, but subject to book building, and now it's 74%. That's right, 32% decrease. And the subsequent year, it's right around the same number, 27% decrease, no? And 2022, 35% decrease. Okay, so it's a question to us regulators in the sense that I don't think it's an over-promise per se, but probably it's really realistic expectations on the part of both the issuer and the deal team, because the issuer, when they fixate on the upper end, maybe if they don't get it, they don't fill up the book, they say, let's try again, maybe some other time. It's probably not something that we would like to happen. And the local take-up versus the foreign take-up on the left-hand side of the slide is also something that's that I thought was interesting. While I said that the local percentage on average daily, right, is actually more than the foreign, but when you look at the public, offerings, the yellow part of that slide is actually the local take-up. Okay, but now it's very challenging as we see that equity would probably last in line if you have dry powder, right? You have the very attractive time deposits that people now are very much into. Of course, the yields given by the corporate bonds or even the government securities. So we'll take that. No, it's a function of the environment right now. But nevertheless, what we're seeing is that probably more on the right-hand side of the screen. I hope that we're able to address that. I'm not sure if regulation will address that per se, but maybe that's something that also will send a message to the investors. Now, when you see a downscaling of the offer size, it's not a positive message, not just to us, the regulators, but also to investors. And finally, we do have some relevant initiatives with respect to liquidity. As we look, the topic is capital raising, given the structural issues that Stevie mentioned. The concept of us being a long-only market has always been a tag that we've been given. But we don't have derivatives yet. We do have some warrants, but we need to come up with futures, forwards and futures, and hopefully single stock options. But here, pending that, it's really just the traditional ability to short sell a stock. Okay? And underpinning that really, and I'm sure some of you are very familiar with that, your ability to borrow, because you cannot sell something and not deliver, otherwise that will you will default. No? And by the way, we already are going on a shortened settlement cycle by the 24th of August. No? It's not anymore a 3-day settlement. We're going to do a shortened settlement, 2 days. Among the last in ASEAN, but that's very deliberate on our end. So I go back to short selling. That should be supported by a robust securities borrowing lending facility. And that's where probably all this press is circling around. No? The presence of, to us, we always believe that the gatekeeping role cannot be digitized. No? So the lending agent would also have to play a role for transparency and essentially connecting the borrowers with those who need the shares for whatever purpose, maybe to support their short selling activity. So that's in the works. And if we can open up our market via bilateral collaborations, we toyed around with the idea of ASEAN linkage, which is across 6 countries, but we quietly pulled the plug around 2018 because it didn't work. Regulations, as well as the fact that on the post-trade, we don't have a central clearing and settlement mechanism, unlike in Europe, where it is really the Euroclear system that's able to do the multilateral netting. So this one, we went back to the drawing board and see probably let's do a bilateral, and we're working with the Shenzhen Stock Exchange for a pilot project. And I hope with that snapshot during the Q&A, if you have questions, I'll be happy to answer them. But essentially, we've gone probably from, I never thought that Vietnam would overtake us, in all humility, with their daily trading value, what, $1 billion, no? But nevertheless, it happened. I also never thought that probably we'd get investment grade rating. I thought in my lifetime, maybe, maybe not. Then it happened, 2014. So, but what our responsibility is, both as a regulator and listed company and technology provider, is really to provide access, because when you have investors coming in, the first thing that's in their mind also is how do I get out, right? Whether that be on the PE side, whether that be on the anchor investor side. And that is what the exchange just primary role is. Provide that facility, that highway for people to come and go and make that an efficient, hopefully globally aligned market. So we will need your support. I know this is Finex. We need all your support, not just for our reform program, but also really, we cannot do it alone. And we probably will have to do all the heavy lifting. We cannot do the heavy lifting without your help. So thank you again for inviting me as well. And I'll see you around. Thank you.
Thank you. Thank you, Roel. May I invite our speaker, Mr. Stevie, and Ms. Malu Cristobal, also, who will be acting as our moderator for this afternoon. If there are questions from the floor, please, I think we have mics, or please raise your hands. Oh, sorry. You can text your questions to the number shown there. So you can also ask your questions in person if you want. So Malu, I turn over the floor.
What I'm fearful of is it is a schizophrenic fund. If you read section 2 on the policy, it's all about national development. If you read section 14 on what it can invest in, it's everything, everywhere, all at once. So do you want a global fund or do you want a national development fund? If they want, I'm in favor of a national development fund, especially one properly structured, like Indonesia's is. But if it's going to be a global fund, let's put things into context. Even at the maximum capitalization, which is 9 billion, that's puny if you think you're going to get good deals. If you go by global asset managers, guess how many you have to go through until you get to a fund manager who manages less than 1 trillion US dollars. 36. You have to go to number 37 before he manages less than 1 trillion. So we're going to compete with that. Okay, it is not doom because it depends on who the board and the management is. But why are we giving that latitude to the board and management? If we just said this is a national development fund, you can only invest in agriculture, manufacturing, infrastructure, and tourism in the Philippines, we wouldn't be having this discussion.
All the structural imbalances that which will possibly be effectively addressed.
Everything can be addressed because they've given the complete power to the board and to the management. But the point is, why are we giving? I mean, so basically, this can change every change of administration. Because the president appoints all 9 board members, they appoint all the managers. It can change just the way GSIS and SSS and DBP and Land Bank's presidents and board and trustees change every administration. My point is, why do you make it a question of governance? And if you can, all funds have a question of governance. But why do you make it so broad? Why don't you make it like somebody asked me, what if we put limits? Why did you make the purpose the limit? That's the simpler one. Why are you making the potential for good and bad so broad?
finding a way to bring and pricing.
I'm going to again be factual, which is not going to be positive because I'm going to be factual. On pricing efficiency, and this is something everybody will tell you privately and deny publicly. Our IPO system is literally the worst in Asia because you have a book build for 2 weeks, then you do the local offering with the participants and all investors and everything. It is the, if you're talking about, okay, let's compare it to the US. In the US, you book build, you price, the next day you're listed. So there's no worry about price movement between commitment and trading because it's literally the next day. You send the money in on the close of business, the next day it's listed. Now, what the most Asian companies do, they basically say, after we do the institutional round for 1 week or less, we have a public round. But the public round is a limited amount and it is come one, come all. It is not allocated to a group that may choose to place it or not place it, to put it on their own book or to give it to their clients. There it's basically, let's say there's a 10% small investor round. If it's 10 times oversubscribed, everybody gets 10%. If it's undersubscribed, everybody gets 100%. So, and then it's a short period and there's no, not what we do in the Philippines here where we have a clawback. All that doesn't stop deals from happening, but it affects pricing and it affects demand, which therefore affects attractiveness. What were your two other things you said about?
Finding a way to that both sellers and diversity.
Okay, let me, I was like shocked at the time when I started doing international deals in the 90s. In the Philippines, you do $100 million or more, you need an international tranche. In Thailand, it's only when it's 200 million or more that they do an international tranche because that's how robust the domestic demand is. And for me, what your point was very revealing on the level of domestic demand. Now, why is domestic demand low? Even compared to Vietnam, which is roughly the same GDP per capita. We can take two approaches to deals. You can take Henry Ford's approach, which is you can have, when the Model T was started, he said, you can have it in any color you like as long as it's black. Right? Or there's the other approach, which is, you know, when I retired a year ago as an investment banker, a lot of times my junior people would ask me whether it was Evercore, Macquarie. Other companies put option 1, option 2, option 3, whatever that in their suggestions for when they're pitching to the client. He said, are you so confident that you only put one option? Are you so sure they'll like it? And I smiled and I said, I'll tell you my secret. I asked the client first, before the pitch, what do you like? And we would discuss for 15, 20 minutes. So by the time I gave my pitch, I knew what he wanted. Give the investors what they want and they will come. Force them to buy something they're not interested in the immortal words of Yogi Berra, if people don't want to come, nothing can stop them. So let's do the opposite. Who are we targeting among retail investors? What do we say? What do you want? You want a competitor to time deposits upside? Then encourage them to buy and offer high dividend yielding stocks. Are they saying, no, I'm very happy with time deposit rates, I want upside? Then, you know, my point is, are we actually supplying them with what they would consider buying versus saying, eto, why aren't you buying? You'll get more demand. Like, look, I'm old enough in 1995 to remember what happened in Petron IPO. That's the first and only IPO where there was really mass retail demand because it was a stable stock, it was a well-known name, and there was a good dividend yield put in. Give them what they want and they might learn to like other things.
First, no minute. Let me give you your balances.
We could still see the dividends yield or the returns that investors are looking for. They go to other asset classes. Because if you look at equity, not only is it expensive to fundraise, but also, in our country, dividends are never guaranteed, right? The framework of law. Only when actually, even when it's declared, I've seen a lot of dividends that have been declared back in the pandemic being revoked by the board because they need the cash. So, as opposed to a contracted cash flow proposal for fixed income. So, you cannot compare when you look at, no matter how you see the yield curve to be inverted, probably 5-10 years doing 6%, and then the longer tenors would probably fetch a little bit closer to that, but it still does not compare, let's say, to if we have the rate, some rates would give 4 or 5%, and that's pretty much the closest proxy to a fixed income, because in a REIT structure, the requirement is that you are mandated to declare dividends if you want to take advantage of the fiscal incentives given under the REIT law. But that does not apply to an ordinary stock. Right. Really look at, let's say, the less than 300 we have, and what we've seen is that the active trading is probably just 20, 30 companies. The rest are not being actively traded. So it's a question of liquidity, which you might say structurally, it's the float levels, save for the banks and the others, are very low. They're just barely complying with the minimum. So that's the float. Without the float, of course, there's not a lot of shares that will go around. But I think also that the mindset that a lot of business owners have to understand that when they take a company public, the benefit is also going to go back to them when you look at price increases, or even if you don't hit your initial price targets. If you part with 20%, you're still at 80% owner. 80% of a bigger universe, let's say, right now, 15 times earnings, if that's your target to price, which you cannot get in the private markets, no? Unless you really are a good negotiator. So 80% of a bigger pie is so much better. And that's when we go to the road shows around the country, we work with the SEC. That message itself is not yet coming through. It's not resonating because
Let me say something. Why are there only one-third the number, or less, one-fourth close, of publicly listed stocks here compared to Vietnam? They're publicly listed in name only. Try buying $1 million, you'll double their price. Try selling $1 million, you won't sell it. Now, what is the solution which Finex, SEC, and PSE can work together on? It's not rocket science. It's done in other markets. Market makers. You go in New York, London, NASDAQ, Hong Kong. You're public, whether you're small cap or big stock, you are required to have a market maker. What does that mean? If there is a proposed seller, you have to buy it. You don't have to buy it at his price, but within certain bands, you have to provide liquidity. Somebody wants to buy, you have to sell. The market maker keeps an inventory to buy and and has capital, keeps inventory to sell and capital to buy. You go to New York Stock Exchange, look, I always joke everybody, I have 100% market share of Philippine listings in the New York Stock Exchange because there's only one PLDT. I was the one who offered it in 1994. But getting back, they had to choose three market makers, okay? So that there would always be volume. The entire issue, because it was a convertible preferred, was just $200 million. Wasn't that big? But they have to have three market makers. I was director of a NASDAQ listed company, a tech company. They had to appoint two market makers in NASDAQ so that there would always be volume. So if you have people who are listed in name, but then I buy the stock, I cannot sell it. Why will I buy it? I want to buy it. Nobody's selling. Will I care? You think I'll come back in 2 weeks to say, is the price still there? I'll just say I'll move on to something else. If you're going to be publicly listed, that doesn't mean I save on my tax when I pass it on to my heirs and inheritance. It means I'm supposed to be able to buy and sell it every day.
Just to also share, no, that idea we've thought of. It's in fact for exchange traded funds we have that requirement. So it has to be, you have to have at least two market makers. So that's something that we're evaluating, but the float has to be adjusted also because the 20% or the 10%, a lot of companies are really just doing 10%. They can't go below because they'll attract a different tax structure. I guess on the market structure itself, that has to be, if I give up, like for a REIT, some corporates are willing to give up 49%, so much higher. Of course, the threshold there is 1/3, right? So
the NASDAQ company I was part of listed 8%. It doesn't matter if there's adequate trading. You will not care what percentage was floated. You will look at what's the daily volume buying and selling because that tells you how much you're willing to buy or sell. I can list 50%, but if and then I buy back 40% and I don't trade it, what was the point? I think it's the same issue. If I have a definite, okay, the whole idea with listing a bond is not to raise money. It's so that you raise money and the investor can take a position, like let's say it's a fixed interest rate, not floating. He's taking a long-term view on where interest rates will go and his holding period. If he wants to change his mind, he can then sell it. So if it's the second tier, lower amounts, I go back to my simple question, will there be liquidity? Why do I keep a lot of my money in cheap deposits in a bank? So I can take it out when I need it. If the bond market is not liquid except for the bigger names, it's not, I think, that the second line issuers don't want to issue. It's who is buying it. If you look at the bond market, except for the highest name, it's a hold to maturity market. I'm not talking about cheaper. If the price is irrelevant if nobody wants to buy it. No, nobody wants to buy it if it's a second-tier illiquid bond. Pricing is irrelevant because it is not a it is a public instrument in name only. If there's no market and there's no liquidity. asking a girl or a guy, should you date this person? The person say, who? Not, it's not asking, am I going to date or not date? It's who am I going to date? So the thing with the holding company, okay, holding companies are very unpopular in big economies. Why? Because you don't need to buy a holding company. You can buy specific companies that, why buy Microsoft Holdings when you can buy Microsoft? You don't need to buy a holding conglomerate. Now, in a smaller country, a lot of times, especially given market weightings for stocks. Like for example, Philippines, if you have an ex-China, Japan, Korea fund, we're still like only 5% of the fund of the market weighting. So even if you're, let's say, a $10 billion fund, your market weighting is 500 million for the whole market, and it's maybe double that for Thailand, okay, 10%. Now, you're going to buy 5 or 6 stocks only. You're not going to buy 500. So therefore, you want something that is a proxy for the economy with superior growth, but a proxy. That's why first banks are very popular, because big banks are a proxy on how the economy is doing. A properly structured and focused conglomerate is the same thing. Now, you don't want a conglomerate in the US or in Germany, but in smaller Asian countries, it's a good proxy at times. And then let's also be blunt. In a highly concentrated country, I'm talking about where control of the economy is highly concentrated, a lot of times the conglomerates know how to horizontally integrate. And therefore, very good opportunities will come their way. It's just, they're not making a commentary on whether this is politically or socially desirable, but it's reality. So a conglomerate today might not be what it is 10 years from now, but if the conglomerate knows what it's doing, how to operate the country, it will be in the areas where it should be in. That's why in smaller countries, conglomerates are popular. In bigger countries, they're not.
Well, when you talk to investors, they at least know when you look at the ESG space, and I'd say it's become convoluted for the past, since they came up with all this different standards. No? So I guess the premium, I'm not sure if you can decouple that and attribute that to ESG per se. In the same way, 20 years ago, they were saying if I'm well governed, I will attract a premium of so many basis points because of my good corporate governance. But we all know that the movements could be coming from different directions. No? But that being said, our role when you look at the ESG framework is make sure that if that is your thesis, that's whether you're a fund or whether you're gonna go on a public offering and you're gonna harp on your ESG theme, that there's really clarity, verifiability, because otherwise we're just gonna go into greenwashing, green hashing, all of those things. It's really just fluff, and that's not gonna work well for purposes of making sure investors know what they're getting into, right? Especially when you look at, for example, the carbon credit market. It's been under attack lately because of the quality of the carbon credits. And even if there's people interested in buying the carbon credits, but this is off South Africa or in Uganda, and even with the latest satellites, you don't know if they're actually devoting it for purposes of the intended purposes, no? When they do fundraising. So I think this is a topic that probably will weigh heavily on the basis of what's the parameter. It's I'm not sure if this is a sandbox proposition, but I think in our market, this is still it's something that's very much in the infancy stage. So I don't know if I don't I know I cannot say that in our market because of ESG. Of course, we have corporates that are dark green, for example. There are companies listed in us that are super dark or dark green, and they've been able to get good prices for their bond markets and equity markets. But that's what less than probably 4 companies. So for it to be really a market-wide observation, I think we really have to ensure that the standards. I don't think there will be a universal standard. PRI, GRI, Task Force for Climate-Related Finance, but really make it understandable for people. It's the taxonomy and the jargon is becoming so technical. No? It's our role is, and I hope for Phoenix, is to translate that. And how does that happen? How do you say that you're going to hit these carbon targets, whether that's 0 or not, in 10, 20 years? And what's your monitoring tools? Disclosure will play a key role.
I'm gonna say, first, a lot of my knowledge comes from my son Miguel, who's a vice president for ESG at Morgan Stanley in New York. Okay, so that's probably what he says. It's not my original. But first, while there are issues on what ESG really means, that it has to be fine-tuned and all that stuff, let me be really blunt. ESG compliance doesn't mean a premium, but ESG non-compliance means you're shut out. It is more the negative than the positive. I can tell you, I talk to international banks. For example, let's use a simple coal. You don't have to pay off your existing coal loans, but no more new ones. So that's what I'm saying. So, and there are all these scores now, and then a lot of these funds will say, you don't have to sell your existing investments, but you cannot add. And any additional proceeds, if you have an open-end fund, cannot be used in anything that is not legacy. So they're basically being pragmatic and saying, if you're already there, fine, but you can't add. You can't continue. A very big stake, because unless you're in a country that they will continue to lend to you domestically, you're already finished for new loans and refinancing globally. So that's just the reality. So I don't think it's a premium. It's you're shut out if you don't comply.
Okay, yeah, we have several questions now. Okay, I have a question because Stevie, you mentioned that we have to go to manufacturing, right? And if you look at manufacturing, there's so many structural challenges, which you also pointed out, supply chain issues, lack of roads, you can't get your products, etc. So one of the areas which you mentioned and which people have been looking at is potentially to participate in the EV supply chain to manufacture those. No? Now, I heard a consultant recently say, one of these consulting firms, he thinks we've missed the boat already, the Philippines, if we're trying to get into that now. So I'm just wondering what your view on that is. Have we really missed the boat, or is there still an opportunity for us?
My honest answer is I don't know. I'm not an industrial expert. I'm not a management consultant. I don't know. But if we're going to get back to manufacturing or get into manufacturing, since we never were, we need two things. One, start with where you already have the raw materials. Like, for example, why do Thailand and Malaysia have a petrochemical industry and we don't? When they found gas in the Gulf of Thailand and Gulf of Malaysia, they share it, okay? Did they just use it for power like we did for Malampaya? No, they built a petrochemical industry on the back of that, combined it with the rubber industry, and it led to car assembly because supply chain was met. Okay, you had petrochemicals, you had rubber, and you had steel. Then you can start. Now, what do we have? We have minerals. We export copper concentrate nickel, raw nickel. We don't process it. Look, I said this in an ANC TV show. Indonesia, 5 years ago, said no more raw nickel exports, period. As of today, the nickel industry in Indonesia in 5 years has increased in value by $70 billion by capturing the supply chain. And because they produce 40% of the nickel in the world, just by saying now you manufacture, you process it here. Why don't we do the same for our copper, our nickel, our iron ore to start with? I mean, fantastic. We export it out and it comes back as finished products. Not even intermediately processed mineral goods. We already have an advantage there. Second, I'm sorry to be blunt, but sometimes you really have to subsidize certain things. I was asked to help privatize Genco number 2 in Vietnam, which is state-owned. And they said, it already failed 3 times. I said, why? It's state-owned. After leverage and exchange adjustments, the ROE for the power plant, which was 1,500 megawatts complex, was between 1.5 to 2.5%. That's it. And I said, who will buy it if it's too low? Well, if nobody buys it, we'll keep it. Because it is necessary to make our manufacturing competitive. And for every generating job, maybe we lose there, but the manufacturing, look at the multiplier effect we create. We're not going to keep it at this price forever, but we need subsidized power rates to have a critical mass. Guess what? Indonesia did the same thing in the 90s and 2000s. They subsidized power and fuel rates. Then when it reached the critical mass, they eased off the subsidies. So nobody said subsidize forever, but how did they jumpstart and get people to go? That's how you start manufacturing. Like people tell me, oh, what do we need to bring in foreign investors? I said one thing. What? Profit. You know, in Vietnam, guess what percent you can own of telecom? 0. Banks, 15%, one shareholder, total foreign 30. Petroleum, 0. Yet they're booming. Why? Because the people who go there make money. So people will put up with this and put up with that if kikita sila. You know, Myanmar has lots of incentives, but nobody's going there. Why? Because they won't make money.
Hi, Jang Pascual. Good afternoon. One of the areas that we are looking at in Phoenix, and I address this to both Roel and CV, is greater participation of retail investors in the capital market, and this is why last year we were trying, or was it the year before, we were trying to push the pension reform bill, which has evolved into the capital market reform bill or development act or something. But I just wanted to test whether, you know, the main reason for this is to get more access to funds, to have more more funded retirement plans that will then be made accessible to the market. I don't know whether in other countries, TV, retail investors play a big part, or and will this actually make a dent in creating a more vibrant capital market because of additional funds, as well as I think the bill also pushes for financial literacy amongst the retail investors.
I'll leave it to you to answer, but all I can say is yes, the level of individual investor and retail is much, much higher, more than double in every other ASEAN country. I mean, I'll defer to you if I'm correct, but I gather it's at least double, sometimes more.
I'd like to answer that by saying, for the retail investors, probably the first jump up would really be collective investments. And that's probably the safest way for them to participate at the first instance, whether that be through UITF or mutual funds. But that being said, the issues that we've seen, for example, that a lot are unbanked, and we know that that's a structural issue. That's why with the advent, let's say, of electronic money, and then it's good that the BSP is supporting that. It's kind of open it up that you don't have to have a bank account, but you could use the e-money services or the VASP, they call it the virtual asset service provider licensed entities to at least access certain opportunities. No? So, Jeng, in terms of the the numbers, I guess it's really screaming in the sense that the entry point is not there for them to participate. Not even talking about products that they can choose from. That's really just the structural. And I guess in terms of when we saw Isabong, for example, no, there's really a big pickup in terms of interest. But when we partnered with the e-wallet providers, we're seeing that the interest level will take time to be very objective as well. And so we're saying, why is this happening? No, I guess to that end, when you see, it's not a question of it being expensive, it's not fractionalized yet, but that could probably be another phase if there is to be a sachet pricing via fractionalization. But it's really just the mindset that we're seeing. It's a cultural change because the people who have the e-money, for example, no, and if you're thinking that they don't have yet trader accounts, to convert them to consider using that electronic money to invest, that's the pain point that I thought would not be as difficult, but I'm seeing that now it's going to really take time. So the concept of retail participation, if they're not yet participating because they're not yet in the capital markets, the next universe would really be those which are unbanked. And that's where the electronic money and the e-wallet providers, we hope that that would lead us to a more, probably a better outcome compared to doing nothing instead of just doing advocacy and outreach, because there's really that structural issue for them to participate in. KYC, I don't think is a problem because they were KYC'd when they participated in the e-money, e-wallet story. So, of course, some people don't even have IDs. So, but that's the gone past that point. It's really just making sure that the mindset and the expectations are aligned with what's happening. Otherwise, they open account, they don't trade. Same way you look at formal brokers, they open account but they don't trade. So we don't want that to happen, and we're probably trying different models for that.
Okay. Most of the issuances in the past few months are perpetual prefs that are equity informed but really behave like fixed income. And as Attorney Ruel pointed out, most of the issuances in the last year were done at a discount but are still underperforming. And the things that Stevie mentioned will take time. So my question is there one thing that at least we can do that does not require legislative action that we can really realistically do to spark some life in our market, equity market? Because really, I mean, sub 100 million is pathetic. Is there just one thing that we can do? That's my question.
On our end, it's really just giving more choices to the retail investors. If they don't feel, for example, when you say more choices, brands that they actually use, brands that they actually, are very familiar with, whether that's service sector or consumer sector, because otherwise it's still going to be where we are right now for purposes of, we've relaxed the rules, but you can only go so far when you look at
Nothing
relaxing the rules.
regulatory within the PSA control because you're saying more issuance, right? But it will also take time.
So that's where the we always say the regulations are there, but if they have other considerations in terms of going public, or they have fears probably to see an outsider in the boardroom, and that's something that has to be resolved first before we even have an eye-to-eye discussion. Otherwise, we're crossing lines. We're not meeting head on in terms of it.
I don't believe in short-term solutions unless it's an emergency. But if you want one thing, market making. Why will I buy if I cannot sell? Why will I sell if there's no buyers? And it's something done in most other exchanges. You want a publicly listed company to trade as a publicly listed company, not just list. The problem is in other countries, there is no tax benefit to listing. So the people who list because they want to. Here, there's a huge tax benefit. So you have what I call Mona Lisa listings. It just lies there and it dies there. Okay? So if you have forced market making, there will be forced trading. And then people are willing to invest big, small, medium, bonds, prefs, stock. Because if I get in, I can get out. And if I want to get out, there'll be people who will get in. Investor, it's not fair because the investor is there to do something rational, not to do something irrational. So it's unfair to ask him that. Now, the regulator can do things to make the scope of what is rational bigger. But it's what you're telling somebody, put in money and bahala na if you lose it. It's not rational.
Well, we've seen the pandemic.
He doesn't need to be enticed to do that. I have a very high risk appetite. If you saw my portfolio, you'd scream. 70% is illiquid. It's not even listed. I'm very high risk portfolio because I have no debt. I'm 64 years old. My youngest child is going to be 32 years old next year. I can afford to do that. I don't need to be enticed. I just need to find instruments I like.
I guess really just managing expectations when you go through whatever process that interfaces with the capital markets. Otherwise, that probably are unrealistic targets for them, then probably they're going to be dissuaded when they see that it's not going that way. Not bold, but making sure they also temper expectations.
Thank you, Malu, Stevie, and Ruel. We'd like to take this opportunity to provide tokens of appreciation to our speakers, to our president.
I guess a closing remark is anticlimactic, right? So I just wanted to say good afternoon. I hope it was still a good afternoon, even if our friend Stevie actually gave you a heavy dose of stark realism on what the whole economy is all about. But then at the end of the day, we are all big boys, and I know we can all handle the truth, right? And in the case of Attorney Ruel, he did mention that the stock market mirrors what the economy is like. So that explains why our economy is like that. But I believe that we Filipinos are resilient. We know how to survive, we know how to overcome, and we know how to thrive. So there was a call to action. I'm sure all of us here will not allow ourselves again to be outside looking in while some people get the benefits of deglobalization. We were talking about Vietnam, but hey, if you look at the chip manufacturing, it's going to Cambodia, please. So let's do something. There was a call to action. Public-private partnership is the key. So let's work on making the Philippine future a better one, not for us, but for our children. So good afternoon again, but I'd like to thank my team, Manny, Abby for inviting the guests, and of course Malu, our moderator par excellence, and the programs committee, and also of course our hardworking Phoenix staff. And have a good rest of the day.